joining Invest Hong Kong's webinar. Today, we have the pleasure to welcome Nigel Smith, Managing Director of Colliers Hong Kong, to share with us the latest developments in Hong Kong property market. Nigel has spent the last 3 decades designing, marketing, and leasing office buildings and mixed-use projects, such as the ITC, IFC, Ping An IFC, Shanghai Tower, and China World Tower. He has extensive knowledge of the city and takes an enterprising approach while solving the most difficult of challenges. He is a fellow of the Royal Institution of Chartered Surveyors and the Hong Kong Institute of Surveyors. Nigel is passionate about leveraging his knowledge to help drive change in the business world, especially when it comes to the workplace, diversity, and wellness. If you have any questions during the webinar, please send them to the chat. Over to you, please, Nigel.
Thank you very much, and good morning, everybody. 3 decades does feel a long time when I think back, and I actually arrived on the 1st of October 1990, just as we entered the Gulf War, would you believe? But things turned around very quickly as Deng Xiaoping did his southern China tour, if you remember that, around 92, 93. And the market seemed to trend upwards right up until really the beginning of the Asian economic crisis, which Hong Kong was one of the first economies into that cycle, which turned the economy down from 1998 all the way through to 2003, when we hit the bottom of that cycle with SARS. And then since 2004, the markets have pretty much trended upwards, albeit with the global financial crisis in 2008, 2009. So let me just try and bring you into perspective of where we sit in 2020. And given the events of yesterday, which some people are calling Black Monday, of course, I have a presentation that was prepared and finished on Friday, and how the world changes in just one day. So I'll try and anecdotally add on what I think based on what happened yesterday. Okay, so that's perfect. Thank you. Well, let's just now put that to the very first slide. Hopefully you've all got that on your computer screen. I think it's always important to look back retrospectively and try to think how it will pan out over the next 1 to 5 years. If you look back in terms of just purely the GDP, you can see the 2 major downturns in '98 with the Asian economic crisis, and again in 2009 with the global financial crisis. Oxford Economics, who we use as a benchmark, have downgraded recently Hong Kong's GDP from 2020 from 2.0 to 2.8, as you can see on this chart, and factors in the downturn last year and obviously the first financial deficit in 15 years. So why is this? Well, of course, it's the triple whammy that people have been talking about. It started with the trade war, which now has been going on for almost 18 months. Continued then during last year with the protests, and then started again with the coronavirus COVID-19 outbreak in December, which we're hoping here in Hong Kong is starting to stabilize and see a turnaround. Of course, this has had an impact on the economy and therefore in terms of the real estate market. But we do believe that the market this year, in summary, will be 2 halves. It's obviously unpredictable and unstable in the first half, but with a turnaround and a recovery even for the second half. And I'll explain that as we go through this presentation. What I want to do is go through each of the different sectors, and then I'll bring it together towards the end and also look at the budget to compare it with SARS. Just in terms of the capital markets, what's interesting, if you take a look at the right-hand slide, 2016 was Brexit, and that's where really Hong Kong and the rest of the world readjusted itself in terms of the risk balance, particularly for global investors. And you could say whether Asia or Hong Kong looked less risky or Europe looked more risky. In global investors jumped in, and as you can see, that really quite steep upward curve to the end of 2018. Now, these are for investment transactions over 100 million. And of course, in the heading, you can see that that has since dropped during 2019 by 43%. And where were those major falls? Well, primarily in the office market. Of course, in retail, as you would expect, with tourism being impacted, particularly last year with the protests, and again this year will continue to be affected. But I think it's important to understand one fundamental challenge, which is a positive challenge that Hong Kong faces, which is actually a supply challenged market, which means ultimately, if demand falls because of the lack of supply, prices don't necessarily fall at the same rate. And in the example of the en bloc office market, the grade B market, some grade A market, those prices have tended to hold firm. And this is the difficulty when analyzing Hong Kong specifically. It's extremely stratified market, so we do need to break it down into the very individual constituents. This chart really shows how Hong Kong tends to track real interest rates. And of course, we are in a low interest rate environment. Going forward, the Federal Reserve last week dropped it by 50 basis points. And we will see that as a continued opportunity to support prices, not in every sector, but just as a general rule. This one looks at grade A office rents, grade A office prices as it relates to real interest rates. And there has been a general correlation, as you can see from this graph below. But of course, the big question is how much global impact will there be on the Hong Kong market, even though there is this low interest rate environment? And I'll try and talk to that a little bit later on. Stepping back, we as a company held an annual survey. It's done around November and presented in the early part of December. And we asked investors, international investors as well as local investors, what is it that they were wanting to see? Now, I do emphasize this was November before coronavirus broke out, but you can start to see some of the key elements of where are the opportunities for 2020 in the capital markets sector. Now, office, not en bloc office, as I mentioned earlier, we see that prices there may hold, but the strata type of single unit office premises available in certain buildings, where prices actually accelerated faster than in any other sector and probably has more pressure to come down versus something like industrial, for example. So that is definitely an interest to investors. And you can see on the right-hand side where they're thinking they would place their money between value add, core plus, opportunistic, and then core investment. It was definitely a positive feedback at that point in time, and I think it bears the reality of the supply challenge point that I talked about earlier. They also saw opportunities in hotels, and we do too. We think that sector will turn around faster towards the second half of this year. And some of that will be hotels that will just attract tourists again, as tourists we expect will come back in the second half, particularly from China, but also in terms of conversions and the opportunities into either service apartments or co-living buildings. Industrial is also a key sector. Even though it's our largest sector in Hong Kong, there has been a reduction in supply with the likes of the revitalization scheme 2.1 and now 2.0. And there's been an increase in demand for data centers, and we've seen that across the board from our investor clients. Turning now to the office sector, we track grade A office rents in all of the CBDs and some decentralized locations. You can see on the left-hand side that net take-up, so this is additional take-up, expansion you could call it, of 400,000 square foot as a whole last year. Now that's relatively low in the greater scheme of things, and that is an indication of where the economy was going from because of the trade war and then into the protest. The dots that you see below the bars are actually the fall or the rise in Island East of the grade A office rent. So 5.14 overall last year in the grade A office market as a whole, but you can see it falling in Admiralty, Wan Chai, and Tsim Sha Tsui, but rising in Island East and Kowloon East. And I would like to just highlight Kowloon East. That had the largest amount of supply, 3 million square foot why there was a lot of take up there particularly. And why rents held, because being a decentralized district, rents tend to hold more. Likewise with Island East, rents have been trending there generally upwards over the last 10 years as a number of developers, including Swan Properties, have built new products down there. And as those new products are finished, tenants tend to look to those flight to quality, expansion, contraction, mergers and acquisitions, a number of reasons why they would do that. Of course, all in the backdrop of looking to save money, contain costs, knowing that real estate is your second largest cost on the profit and loss account. On the right-hand side are vacancies, and again, wanting to break this down. Central Admiralty, Wan Chai Causeway Bay and Tsim Sha Tsui arguably have all doubled. But if you put that in the backdrop of global vacancy rate, 4% is actually quite normal and quite stable. Of course, with the exception of Kowloon East, but I've already explained that earlier, there was an increase in demand as supply came on, and thus the increase in the vacancy rate. But even at 9.8 going to 13.4, we don't see that as a major issue. It's just that landlords will have to wait longer to secure tenants or offer more attractive terms, which I'll come on to a little bit later. So just trying to look back in history and take some lessons learned. What's interesting about Grade A office rents is that the reductions from the peaks to the troughs have started to reduce. If you just look at the bottom table, you'll see the number 63%. That was the difference between the peak and the trough for a 33-month period from 2001 to 2003. Then it lessened to 44%. You can see from 8 to 9. And that was a much shorter trough, as you saw that V-shaped recovery come back. And then thirdly, in 2011 to 2013, a 21% drop. So it's interesting to note that the volatility of this market has started to reduce. And that is because Hong Kong is still seen as a springboard into China, and particularly the opportunities around the Greater Bay Area. When we look at the supply, you can see exactly what I mean, particularly in 2020, albeit that 21 to 24, we are seeing more supply coming on, particularly in Kowloon, which is the dark blue bar. But there's very limited supply in 2020, and that will generally hold up rents more than they are going to fall. So we see the largest fall because of recent exodus by a number of tenants and downsizing of some of the financial sector tenants. You can see there we're predicting a 13.1% fall in Grade A office rents in Central Admiralty area. That is the largest fall for all the districts, with an average of 9.9% down for the year. You can see Island East still holding firm, very steady at 0.7%, effectively stable. And Tsim Sha Tsui have also been affected. And the reason we see more effect in Tsim Sha Tsui and perhaps even Kowloon East is because of the nature of the tenants there, which tend to be more trading and manufacturing. And we see those as being sort of more impacted both by the trade war, but also more recently by supply chains due to the coronavirus. If you step back and have a look at that rental trend, the right-hand side chart, you can see the top blue line, which is the volatile Central Admiralty sector. And then towards the bottom, in red, you can see that stable line running up for Island East. If you want to put real numbers against it, so as at January 2020, Central Admiralty, the average rent there were $128.3 per square foot net effective. And you can see all the different numbers. Hong Kong still is quite incredible in the sense that the change in rent by distance, it's almost halved from Central through the Wan Chai Causeway Bay. And that's effectively a 5 to 10 minute taxi ride compared with the West End of London, which has a much bigger area. The rents are far more stable. But you can see the changes there. I won't go through them now, but the average perhaps is the most interesting, 73%. It still puts us into one of the most expensive cities in the world. This doesn't include the government rates or management fees. Those get added on top. But the overall trend, as you can see from the chart, has been generally upwards. As I said, as multinational corporations, but also the growth of Asian corporates, whether they're family controlled or state-owned enterprises, also seeing Hong Kong as a base for need to be located here, whether it's to buy or to lease. So we've seen an influx of Asian corporates as well as the multinationals looking into China and the Greater Bay Area. Of course, the numbers in January for exports dropped significantly. You can see at the top there by 19.5%. That will continue. And it's not just cargo freight by ship, it's also air freight now that has been affected. But if you see the ramp up between 17 and 18, that was primarily to fuel the demand in Greater Bay Area, as a lot of companies were supplying through Hong Kong, particularly logistics, and then air freighting it or sending it up by truck across the border into China, depending where the final location or destination is going to be. This is a very stable market. It shows very low vacancy rates and high resilience. And as I said in the second point, their revitalization scheme 2.0 will provide further opportunities for redevelopment. But there's also an interesting factor. The first point, the growth of the data center. And we saw that in the budget. There's more budget going towards IT and technology, Hong Kong Science and Technology Park particularly. We know about the Lochama Loop and what's going on across the border in Shenzhen and how can we tap into that. So we have seen an increase in the demand for data centers and buildings being turned into data centers or redeveloped for data centers. Likewise for e-commerce, we have seen a spike in online gaming and online commerce and buying of goods because of the coronavirus. I suppose that was to be expected. I'm not sure how long that will last, but I think it's an overall trend that will certainly continue. The issue is where are the rents and the prices going? Well, with the overall global softening, again, Oxford Economics reducing their global forecast from 2.5% to 2% just recently, that is going to have an impact on the pricing and rents for industrial properties. But overall, you can see that line being slightly downward after this incredible rise since 2016, but generally flat to slightly downward. As we see some of those 3PL providers, warehouses, really being affected by these supply chains. Of course, at the end of the day, Hong Kong is so reliant on China, and if China consumer demand picks up, that may well pick up demand, as I said earlier, in the Greater Bay Area, for example. Will be very interesting to see how those prices and rents start to trend. But overall, we see this as a very stable sector. Retail inevitably has been the hardest hit for the longest time, 70% down since 2013. That's in line with residential, but I'll come on to that in a second. So how do we make sense of this? Well, the tourists have effectively stopped since the beginning of this year, but were slowing down dramatically since the middle of last year. I said earlier, when they come back, you have to assume that they'll start coming back, particularly from China, probably in the south, perhaps in the middle, as well as Greater Asia. You can see on the top line, the chart there, the left-hand side highlighted in blue, you can see that minus 11% for all retail last year. And then the breakdown as you go through jewelry and watches, 22.4%, electronics, 15.6%, and so on and so forth. As I said, it peaked in 2013. It's approximately fallen about 70%. And as you'll see later, there will be further stress in that sector. But there are some opportunities, inevitably. Again, it's a supply challenge market, would you believe? Trying to get prime high street shops is hard, and this may be an opportunity for some investors to jump in. It's also an opportunity for international brands to get a foothold in Hong Kong. And we as a company have seen a number of our clients doing exactly that. The long waiting lists in the big shopping centers such as Harbour City and IFC have thinned, of course, and there should be no surprise there. But that's an opportunity for new brands to come in, and that refreshes the overall experience that you get as a consumer. We still see the long-term opportunity for retail in Hong Kong. It is what we do, and you can see that people like to go to shopping centers, but inevitably their tastes and styles will change. So you've got at the bottom there opportunities towards athletic, leisure wear, and fitness. Fitness obviously down a little bit at the moment, but that is coming back. Lifestyle and department stores, of course, people are eating at home more at the moment, but that was a general trend, and you can see those numbers coming through from the linked REIT course, the coffee culture that wasn't around in the 1990s, unfortunately for me, but has really picked up over the last decade. The light refreshment is a new F&B concept. F&B is still going to be a struggle, but the struggle this time is less about rent and more about competition and the thirst or the need for new concepts to come into Hong Kong and to drive that interest level. So there is some opportunity in the retail market going forward. It will be difficult for the next 1 year, but then it starts to turn around. But the way to look at it is what are the opportunities that both developers and new brands can see. I mentioned the residential sector earlier. Before we jump into that, again, another correlation between residential price growth and, in blue, the real GDP growth. It has split, as you can see on the right-hand side, but if we go back to the left-hand side of the chart, you'll see that incredible V-shaped recovery through the global financial crisis as all the economies around the world entered their quantitative easing. That push rebounded Hong Kong, and the big question mark, as it did after SARS, but it's slightly different, is whether or not we will see such a rebound, maybe not in such an extreme way as the 2009 experience, but certainly a rebound as we see the economy starting to come back to normal, as I said, in the second half of this year and then beyond. But at the moment, GDP is down. That will have an impact on residential prices as a whole. Although it is very different this time, it's important to note this, that the resilience of the market, there are fewer people who are overextended. The government has put in place a number of policies that actually reduce the sale and purchase transactions. All of these factors have helped to actually stabilize the residential market. So what do we do? It is very stratified, as I said earlier, particularly, but before we get into that, let's look at what are the pros and the cons at the moment. Well, we talked a lot about low interest rates. I haven't mentioned before, but the government relaxed the LTV ratio below $10 million, 80%. We saw an upsurge in purchases as soon as they did that. And there is still a strong pent-up demand. No question about it in Hong Kong. There's a lot of cash in bank accounts that need to work a lot harder than the interest rates that they're getting on that cash. But of course, that is offset particularly by black swan events. And you could argue that protests last year were a black swan event, but actually it wasn't in some respects compared with coronavirus, COVID-19. There is an underlying issue around rising unemployment, of course, now, particularly F&B, retail, tourism, and the trade war uncertainties will continue to concern a number of companies, a number of owners. But when you consider that more than 60% of ownership has low or no mortgage or debt on their property, the pressure to sell is going to be far less, unless, of course, somebody wants to leave Hong Kong for good. And then that is a different story altogether. If you look on the right-hand side, you can see the recap of 2019. So we split between mass residential and then luxury residential, which is effectively the second-hand market, over 1,300 square foot. You can see the prices holding in the mass residential market. I talked about a number of government levers that they can pull on and pull off at any time, so that is relatively stable. But it is coming off if you continue to the right. We recalibrated our numbers post-COVID-19, so we are seeing some softening in those mass residential prices and to an extent the rental by 5% and 3% respectively. But it's really the second-hand luxury market that is really interesting because that may see some extremities. I personally believe 8 to 10% is going to be the maximum as an average, but there will be potentially up to 15% fall in some districts by some sellers wishing to accelerate their sales price. But bank valuations are tending to hold up. Low interest rate environment, we've talked about earlier, is really holding some stability to that market. But there's definitely an opportunity to jump in to properties at up to a 10% discount. We've already seen, literally, we've already seen people queuing outside real estate agents when a flat has been discounted by 8%. And that is quite interesting. So the floor seems to be around that 8 to 10% mark, but there will be some other opportunities. There's very much the opportunity to jump in at I did promise to have a very quick look at compared with SARS. Well, I think really the big number is 70%, which I mentioned earlier. That was the drop. Actually, it was 62% from 98 through to the beginning of 2003, and then it dropped a further 8%, so a total of 70 to the midway point in 03. And then effectively turned the corner very quickly. And there was a number of reasons for that. Because of the CEPA scheme and the individual visit scheme, Hong Kong was chosen as a global financial center, and that reboosted the market. And that started the upward trend from 2004 onwards, albeit there was the global financial crisis blip, which I can say for Hong Kong, because it was a V-shaped turnaround there. Now you compare that with COVID-19, most sectors peaked relatively recently. There hasn't been this long downward smile, if you can call it that, but it definitely peaked about the middle of last year, with the exception of retail, as I said, which peaked in 13. The residential price correction, which there will be one, as I said earlier, will be relatively mild at the moment. Again, things are changing on a daily basis, but based on what we see, and with the US 10-year at the lowest point in 150 years, that is effectively reducing discount rates, which in the longer term will uphold values, albeit that there will be short-term falls because of the issues around the triple whammy, as we said earlier. Generally, office rents have tumbled up to 2003. We're not seeing them tumbling now, albeit you could argue a 13% fall in Grade A office rents in Central Admiralty is a big fall, and it is, no question about it. But overall, at 9.9%, given what's been going on over the last 18 months, that's all well within reason. And just finally, on this slide, bottom right, hotel room rates fell to the mid-year point by 20%, but then actually recovered by about 13, 14%, come back up to an overall minus 4.7%. That's quite a turnaround as those tourists came back. But how much of that was because of the individual visit scheme, you don't know. But at some point, as I said earlier, hotels will rebound for redevelopments or just pure tourism opportunities. And that's the sector that you should look at, particularly given the 10-year rate. Finally, just to mention a couple of words on the budget. Yes, it was the first deficit for 15 years. There are issues fundamentally in the economy that need to turn around. We have the opportunity of the Great Bay Area, and a lot of the tax dollars are paid in or covered by the residential sites. There's 15 residential sites slated this year and 6 for next year. I'll just jump to this slide. So out of the 21, 15 private residential sites will provide only 7,500 units. You can see on the right upper side, the chart there, how we've trended downwards from 35,400 per annum in 11 and 12 to now to 15,000, and that could be even lower. So there are concerns about the longer term housing issue, but that will force developers to look elsewhere, particularly into developing brownfield sites, and the government is on top of that. So another 6 sites on top of the 15, that's about 9 million square foot. That's in line with normal supply, so we're quite comfortable with that. As I said, Hong Kong is generally across the board supply challenged market. This is too small to look at, and I'm not going to read it, but let me just tell you what we think are some of the highlights. The government on the left-hand side with office is trying to pump better measures into the financial sector, or with a smaller end of the scale and through transactions that will have an impact positively on the office market. Retail consumption will change. There is a boost in that through the government budget, and our view that that will turn around in the second half of this year, but there is a longer term play with retail that I mentioned earlier. And then industrial, the steady eddy, but very much centered around data centers and IT are the opportunities there, particularly demand-wise. So perhaps I would just like to wrap it up with 2 and then a final slide. So where are our outlooks and recommendations pointed? So office prices will bottom out around the middle of this year. We see that being backed up by Asian corporates coming in. The sharp in central link that started on Valentine's Day is definitely a booster. And the low interest rates and now low oil prices will definitely help China and those Chinese state and those markets. Of course, strata title offices, I mentioned earlier, is an opportunity from an investment point of view. I talked and touched on revitalization scheme and data centers, so I'll move on from hotels, also the opportunity for co-living, and how that will pan out. And the number of hotel rooms that are increasing, but some will be taken out as well, as I said, because of redevelopment. Where does it sit? Across all sectors, prices and rents. Recap, we just take the top line. So prices down and rents down, grade A office market 5%. Before the virus came out, we were predicting -10 and -8. We're pretty much saying that there's going to be another 5% on that, but we're generally holding the CBD rents. We have seen an increase in demand from PRC companies just recently, and that may well hold up some rents, but there's definitely an opportunity for tenants to seek longer term, to seek more incentives, to get longer rent-free periods, to get a lower rental package, as those landlords are worried about losing tenants, and some of those tenants are forced to move into decentralized areas. Warehousing, as I said, is relatively flat across the board. Mass residential, those numbers again, still continuing to fall, but there's a lot of pent-up demand, so I don't think we'll necessarily see those full numbers at -10 and -8, unless the coronavirus globally impacts China. But we feel that China itself is resilient and is already coming out, and likewise for Hong Kong. Luxury residential will be a little bit more. There'll be the one-offs at 15%, as I said, but I personally believe between 8 and 10% is more realistic for the overall year. And then retail, yeah, it's still the biggest number, unfortunately, -23% this year off the back of a 7% decline. But that is starting to see some baseline and opportunities, as I said, particularly on the investor side, jumping in, particularly with One China, One COP, which is where we're getting our inquiries at the moment. So what are the key takeaways from this presentation? The current market has similar patterns to compared with 2003. So as I said earlier, we're starting with a much shorter time frame. The question is, when will the virus outbreak turn around globally? But in Hong Kong, it seems to stabilize and also is trending downwards in Hong Kong. And we have seen fast rebounds in the Hong Kong market before. The question is, how fast will it be this time? Current office rents remain relatively stable. I've mentioned Asian corporates jumping in, but the multinational corporations will certainly be looking at ways they can continue to cut costs. That's inevitable as they work out what's going on in Europe and North America. We still expect coronavirus should be brought under control by the mid-year point, and things will be back to normal. Most offices are back to normal and business as usual. My office, again, as an example, has been extremely busy over the last few weeks, partly with catch up, but also partly with investors wanting to invest money and tenants needing to make a decision based on lease expiry date. So in the long term, because it's a supply challenge market, we do see a continued steady growth in Hong Kong. The opportunities abound with the Greater Bay Area, which I think is still totally untapped. And many companies are trying to get their head around that. And that will lead on to opportunities down the track. I'll leave it at that if that's okay, Edith. I'd be happy to take any questions.
Well, thank you so much, Nigel, for this very informative sharing. We do have a question from the chat. With the pent-up demand and retail pricing lowering internationally and even in the GBA, how would Hong Kong compare with other major markets from an investment perspective?
I think you have to look at it in two ways. I think, first of all, retail from a decentralized point has been trending upwards. Again, go back to those linked numbers. And that's definitely a positive sector as people are shopping more to eat at home. But overall, shopping centers is what defines Hong Kong. How does that compare with other cities and centers around Asia? Well, I doubt Japan and Korea will see it. Shanghai is definitely a competitor. But if you're coming from overseas, most people will tend to focus towards Hong Kong or Singapore, two very, very different cities and different styles of retail. The big question is luxury goods, and electronics. Will they come back? You know, you saw some incredible double-digit growth, particularly in watches and some jewelry lines. That may not happen again. In fact, it's unlikely to happen again. So we need to see a consolidation, particularly as people tend to travel further afield now. It seems to be more exciting to go to Paris to buy a handbag than it does to come to Hong Kong. So Hong Kong does need to redefine itself as a city within Asia and then globally. That will mean a reduction in rents, which we've already seen, at a more normal level. demand will come back inevitably from China first.
Well, thank you, Nigel. Another question is, how do you see the development and opportunities in the Greater Bay Area from a real estate company's perspective?
Yes, as I mentioned earlier, perhaps a little tongue-in-cheek, but we're still all trying to work out what it means. Look, there is plenty going on. We have done research together with the Royal Institution of Chartered Surveyors to look at those opportunities. A number off the top of my head I seem to remember of the demand for 21 million square meters of office space. There is an industrial belt around the core cities from Shenzhen running round the back, around Guangzhou, but more to the left. So there's an industrial play. We've already seen residential being sold and being built, of course, in some of the key cities. The big question, of course, and what may hold it back in the short term is the infrastructure. How do we get there? What are the hospitals like? And what are the schools like? And do people want to live there yet? And the answer to that is yes, they will in the longer term. How quickly do they move in? So the opportunities for companies is definitely manufacturing. It would probably be skewed more towards IT. And then in the development sector, construction, of course. And then if you look at the Greater Bay Area as a whole, each of the cities playing to their strength. Hong Kong and Shanghai as financial centers. Macau, of course, as the entertainment sector. Shenzhen as the IT hub, and we can all play off each other. So I think we do genuinely need to work out how we can maximize those different cities and then look at the other 6 or 7 that no one's really jumped into yet.
Well, thank you so much, Nigel. Thank you for your time today, and thank you all for joining our webinar today. Please stay tuned for the webinar next week.